Welcome back to the deep dive. I have to say, looking at the stack of research we have on the desk today, I feel like we need to put on some latex gloves.
Ha! Yeah, this is not a clean subject.
Not at all. We are digging into something that, on the surface, seems incredibly dry. Ledgers, balance sheets, audit reports. But when you actually peel back the cover, it's a crime scene.
It really is. We are entering the world of forensic accounting today. And you're right, usually when people hear accounting, they think of a beige office, a calculator, and a very risk-averse person worrying about tax compliance.
Totally. It's viewed as the most rigid, black and white profession on earth.
The most boring, some would say.
Exactly. Math is math. 2 + 2 = 4. There's no room for interpretation, right?
That is the perception. But the reality we are going to explore today is that accounting can be incredibly creative.
And you don't mean creative in a good way.
No, not at all. Not like a beautifully designed building. I mean, creative in the way a fiction writer creates a dragon. We are talking about the moment where numbers stop representing reality and start representing a fantasy.
We are talking about accounting scandals, the cooked books. And the scope of what we're covering today is massive. I mean, we aren't just looking at petty theft from the cash register.
No. We are looking at the heavy hitters from the Enron era that really defined the early 2000s to the massive modern collapses like Evergrande that are shaking up the global economy right now.
And we aren't just going to list the crimes. Anyone can read a headline about this stuff. Our mission today is to understand the mechanics. How do you hide $1 billion? How do you make a company that is bleeding money look like it's the most profitable business in the world?
And perhaps most importantly, why do they do it?
The psychology of the con. I think that's the part that fascinates me the most. We tend to think of these fraudsters as these, evil masterminds, but often they're just desperate people who painted themselves into a corner.
Or, on the other hand, they're narcissists who genuinely believe they are smarter than the market, smarter than the auditors, smarter than everybody. It's a real mix.
So let's set the stage. We have a lot of ground to cover everything from what we're calling the fraud triangle to the Hall of Shame. But I think we need to start with a definition. What is the line between a mistake and a crime? Because I definitely messed up my own budget before, but I don't think the FBI is coming for me.
Well, let's hope not. But you've hit on the key word, the legal pivot point. It's intent.
Intent.
An accounting error is just that, an error. You forgot to carry a one, or you categorized a lunch receipt as office supplies by accident. It's a mistake, a scandal, a fraud that arises from the intentional manipulation of financial statements.
So it's a deliberate act.
It's a deliberate act by trusted executives or employees to misuse funds or, more often, to just misrepresent the truth.
Okay, so it's the difference between tripping over a rug and deliberately pushing someone down the stairs.
Precisely. And in the world of corporate fraud, we generally categorize these pushes into two main buckets.
Okay.
The first one is the most intuitive. It's called misappropriation of assets.
Which is just a fancy suit and tie way of saying theft.
It is. Exactly. The industry term is often defalcation, but yeah, it's theft. This is when an employee steals the company's assets. Now, historically, this meant stealing cash. You're working the register, you pocket a 20.
Right.
Or you're in the warehouse and a box of inventory falls off the truck. The classics.
The classic shrinkage that companies used to budget for.
Exactly. But as the economy has evolved from physical goods to information, so has the theft. Now we see the theft of intellectual property becoming a huge problem.
So not stealing the computers, but stealing what's on the computers.
Right. Stealing the customer list, stealing the source code for the new software, stealing proprietary data, things that are intangible but incredibly valuable.
That seems infinitely more damaging. If I steal a laptop, the company's out, what, $2,000? If I steal the design for the new prototype that's on that laptop, the company could be out millions, or even its entire future.
It can be an extinction-level event for a small to mid-sized business. It's terrifying. There was a striking statistic in our research notes from 2015. It found that 33% of all business bankruptcies that year were caused, at least in part, by employee theft.
Wait, a third? A third of businesses that failed were essentially eaten from the inside out.
Yes. It really highlights the internal controls, making sure you know who has the keys to the kingdom, aren't just bureaucratic red tape, they are survival mechanisms.
Wow.
But while asset misappropriation is common and devastating, it's usually the second bucket of fraud that ends up on the front page of the Wall Street Journal.
This would be the big lie.
Correct. Bucket number 2 is fraudulent financial reporting, or as it is sometimes euphemistically called in the business world, earnings management.
Okay, earnings management sounds so much nicer than fraud.
It does, doesn't it? That's the point.
And this is the one that always confuses people because money isn't necessarily being stolen in the traditional sense, right? The CEO isn't walking out the door with a duffel bag full of cash.
Not directly, no, not usually. In this scenario, the goal is to manipulate the financial statements, which are basically the report card of the company, to make it look better than it actually is.
So they're lying on the report card.
They are. They are overstating revenue, they're understating expenses, or they're inflating the value of their assets, all to create a false picture of health.
So if asset misappropriation is stealing a slice of the pie, fraudulent financial reporting is lying about the size of the pie.
That is a perfect analogy. And the motivation is usually about external perception. They need to secure investor interest, keep the stock price high to please Wall Street analysts, or they need to convince a bank to give them a loan.
Or, and let's be cynical for a second, they need to hit a specific number on a spreadsheet to trigger their multi-million-dollar bonus.
That is unfortunately a very, very common motive. We call it gaming the metrics. If your contract says you get $1 million if the company earns $100 million and the company only earns $98 million, well, the temptation to find that extra $2 million in the cushions is immense.
Just find it somewhere, anywhere.
It's amazing how creative people can get when a bonus is on the line. And the SEC has a whole list of tricks they use to do this. Period end stuffing was one that jumped out at me from our notes. It sounds like a Thanksgiving activity, but I assume it's less delicious. Much less. Period end stuffing, or it's sometimes called channel stuffing, is when a company forces sales into the current quarter that really shouldn't happen yet.
How did they do that?
Let's say it's March 30th, the quarter is about to end, and you're short on your sales numbers. You might call up a customer, a distributor, and pressure them to take a huge delivery they don't need yet. You promise them deep discounts, or you tell them they don't have to pay for 180 days just so you can record the revenue now.
So you're borrowing from the future to survive the present.
Exactly. But the problem is, when the next quarter starts on April 1st, you're already in a hole because you've cannibalized your own future sales.
So you have to cheat even more just to stay flat.
It's a treadmill that just keeps speeding up until you fly off the back. It becomes a cycle that's almost impossible to escape.
It sounds exhausting.
Yeah.
And this brings us to the core question of why. Why do people who are often already wealthy, successful, and respected risk everything? Their reputation, their freedom, to fudge a spreadsheet.
Criminologists have spent decades studying this. The gold standard model for explaining it, the one that comes up again and again, is called the fraud triangle.
I love a good geometric model. Let's walk through the corners of this triangle. What's the first one?
The first corner is incentive or pressure. This is the motive, the why. We just talked about bonuses.
Right.
It's a powerful incentive, but often it's pressure. Yes, a lot of the time it boils down to fear. Fear of failure. At the corporate level, there is just immense pressure to meet analyst forecasts. If Wall Street expects you to make a $1 per share and you come in at 99, just 1 penny short, the stock might tank 10%. The market punishes misses severely.
It's completely unforgiving. And there are debt covenants, right? That sounds like something from an Indiana Jones movie, but it's a banking term.
It is. It's a very serious one. When a bank lends a company money, they often include covenants, which are basically rules. For example, a rule might be your total debt cannot exceed 50% of your total equity.
Okay.
If you cross that line, if you violate the covenant, the bank can call in the loan immediately, demand repayment in full.
And that would bankrupt the company overnight.
Absolutely. So if you're getting close to that line, the pressure to fix the numbers, to inflate your equity or hide some debt just to stay compliant is existential. It's life or death for the business.
Yeah, and then there is the personal pressure, which can be just as strong.
For sure. Things like gambling debts, substance abuse issues, a messy and expensive divorce, or something a little more sinister, like the golden handshake.
I wanted to ask about this. This is the idea that an executive might actually want the company to struggle. That seems counterintuitive.
It does, but it happens. A golden handshake often refers to a massive payout an executive gets if the company is sold or merges. So sometimes you see executives manipulate the books to make the company look like a juicy acquisition target, or even distress it slightly to force a sale just so they can cash out their stock options and walk away with a huge check.
That is incredibly dark. You're essentially tanking the ship so you can sell the wreckage you get paid for it.
It happens, so that's pressure.
Hmm.
The first corner. The second corner of the triangle is opportunity.
The open door.
Exactly. You can be as desperate as you want, but if the vault is locked and you don't have the key, you can't steal. Opportunity arises when internal controls are weak or when the accounting is so complex and opaque that no one can really figure out what's real and what's not.
Our notes mention that industries relying on significant judgments are more vulnerable. Can we unpack that? What does that mean?
Sure. Think about it this way. If you run a trucking company, it's pretty easy to verify your assets. I can go to the parking lot and count the trucks. 1, 2, 3. It's hard to fake that. They're tangible.
Right.
But what if you are a bank holding complex derivatives, or a software company trying to place a value on goodwill from an acquisition you made 5 years ago?
The value is an estimate. It's an opinion, not a hard fact.
Exactly. If I say this patent is worth $100 million and you say it's worth $50 million, who is right? It's subjective. It's a judgment call. And that ambiguity, that gray area, creates the opportunity to nudge the numbers in your favor without it looking like an outright lie.
It's not a lie, it's just an optimistic valuation.
That is the defense lawyer's favorite phrase, and that leads perfectly to the third corner of the triangle: attitudes and rationalization.
The mental gymnastics.
Yeah.
This is how they sleep at night.
This is how they look in the mirror. The fraudster rarely sees a criminal staring back. They tell themselves stories to justify their actions.
What kind of stories?
Things like, I'm underpaid, the company owes me this, so I deserve it. Or, everyone else is doing it, it's just how the game is played. Or, the most dangerous one of all, I'm just borrowing it, I'll pay it back next quarter when things turn around.
And of course they never do.
They never do. Another big one is the noble cause corruption.
Right, the idea that I'm doing this for the good of the company.
Exactly. I'm cooking the books to save jobs. If I tell the truth, we go under and everyone gets fired, so I'm actually the hero here. They reframe the fraud as a heroic act.
That's a powerful rationalization.
And this is all heavily, heavily influenced by the tone at the top. If the CEO cuts corners, cheats suppliers, or laughs about regulations, that sends a message. The mid-level managers feel authorized to do the same. It creates a culture where fraud becomes normalized, just business as usual.
So, pressure, opportunity, rationalization. That's the triangle. But I noticed in our research that the triangle wasn't enough for some modern theorists. They've added more shapes. We have a diamond and a pentagon now.
We do. We are getting into advanced fraud geometry here. The fraud diamond was proposed later, adding a fourth critical element: capability.
Which makes total sense. I might have the pressure and the opportunity, but if I don't know how to hack the accounting software or structure a complex deal, I can't actually...
Right. You need the technical skill and, crucially, the position of power. A janitor cannot commit financial statement fraud. You need the CFO or the controller, someone who understands the plumbing of the financial system and has the access to change it.
Okay, so that's the diamond. What about the pentagon? What's the fifth side?
The pentagon adds arrogance or ego.
The master of the universe complex?
It's that specific brand of narcissism where the individual believes the rules simply do not apply to them. They think they're smarter than the auditors, smarter than the regulators, and smarter than the market. When you looked at the major scandals we are about to discuss, that arrogance is the common thread that runs through almost all of them.
Well, speaking of major scandals, I think it's time to open the doors to the Hall of Shame. We have quite the lineup today.
We certainly do. Where should we begin?
We have to start with the big one. The patient zero of modern corporate fraud. Enron.
Enron. It's almost a cliche at this point, but you really cannot overstate how shocking this was back in 2001. Enron wasn't some shady back alley operation. It was voted America's most innovative company by Fortune magazine for 6 years in a row.
They were the golden child of the new economy, trading energy, bandwidth, even things like weather derivatives. They were seen as the future.
They were. But underneath all that innovation, it was a house of cards. And it was built on two main mechanisms that are pretty complicated but worth understanding: mark-to-market accounting and special-purpose entities.
Okay, let's get technical for a second because this is fascinating. Explain mark-to-market to us. What is that?
So traditional accounting is usually based on history. You sell a widget for $10, you record $10 in revenue. Simple. Mark-to-market accounting is based on future value.
The future value of something.
Yes. Enron was signing these massive 20-year contracts to supply energy. Instead of booking the profit year by year as they actually earned it, they would estimate the total profit they thought they'd make over the next 20 years and book all of it today.
So if I sign a deal that might make me $20 million over 2 decades, I can tell my shareholders, hey, we just made $20 million today.
Essentially, yes. You book the net present value of Alder's future profits. But here is the catch. Predicting energy prices 20 years out is basically impossible. So Enron was just making up the assumptions. They were booking massive hypothetical profits based on their own optimistic models.
So they had huge profits on paper.
But they didn't have the cash to back it up. It's the ultimate paper-rich, cash-poor situation, but on a massive scale.
Yeah.
And when the deals actually went bad, which they often did, Enron didn't want to admit it, that would hurt the stock price.
So what did they do with the losses?
This is where mechanism number 2 comes in. Special purpose entities, or SPEs.
These were the infamous shell companies, right? The ones with the crazy Jurassic Park names like Raptor.
Raptor, Chuco, LJM. These were partnerships created and controlled by Enron's own CFO, Andrew Fastow. When Enron had a bad asset, a losing investment, or a massive debt, they would sell it to one of these shell companies.
So they just moved the toxic waste off their own balance sheet and onto the balance sheet of this other company that nobody's looking at.
Correct. But here's the fraud. The shell companies were backed by Enron stock. It was completely circular. It was like taking debt off your Visa card and moving it to a MasterCard that is guaranteed by your Visa card.
So if the Visa card fails,
the whole thing collapses. And that's what happened. When Enron's stock price started to fall, the SPEs became worthless, and all that hidden debt came rushing back onto Enron's books.
And the craziest part of this whole saga is the auditor's role. Arthur Andersen. They were one of the big 5 accounting firms. They were supposed to be the referees, the independent watchdogs.
They were, but they were making so much money from consulting fees with Enron, at one point it was roughly $1 million a week, that they lost their independence. They became enablers. And when the SEC started investigating, Arthur Andersen didn't say, here are the files, let's get to the truth. They started shredding.
The image of auditors frantically shredding documents by the ton while the feds are closing in is just, it's cinematic.
It cost them everything. Arthur Andersen was convicted of obstruction of justice. They were forced to surrender their CPA licenses. The firm collapsed. 85,000 employees lost their jobs essentially overnight, most of whom were completely innocent.
And the Big 5 became the Big 4, which it still is today.
A stark reminder that trust takes decades to build and just seconds to destroy.
Okay, let's move down the timeline just a year later, 2002. Enron is still fresh in everyone's mind, and then bam! WorldCom.
The too big to fail era, as you said. It was one body blow after another to the market's confidence.
And if Enron was this complex magic trick involving derivatives and shell companies, WorldCom feels almost dumber, like brilliantly stupid in its simplicity.
It was certainly less sophisticated, but no less devastating. WorldCom was a massive telecom company, the second largest in the U.S. They grew by buying up dozens of other companies, but when the dot-com bubble burst, their revenue stalled. The growth story was over.
And the shroud they used to hide this involved something called capitalization of expenses. We probably need to explain the difference between an expense and a capital asset for the listeners.
Right. It's a fundamental accounting concept. Think of it this way. If you buy a sandwich for lunch, that is an expense. You eat it, it's gone. It reduces your profit for the day immediately. If you buy a house, that is a capital asset. You exchange cash for a house. Your net worth doesn't go down. You just have a house instead of cash. You get to use that house for years.
Okay, so expenses hurt profits now. Assets don't.
Correct. You depreciate assets over time, but the immediate hit to your profit is minimal. Now, WorldCom paid billions of dollars in line costs. These are fees to other phone companies to use their networks to complete calls.
So it's a regular recurring cost of doing business, like the electric bill.
Exactly. It's clearly an operating expense. You pay it every month. But WorldCom's CFO, Scott Sullivan, told his team to start recording these bills as if they were assets.
Wait, they took their monthly phone bill and called it an investment?
Essentially, yes. They took $3.8 billion of these daily operating costs and just wrote them down on the balance sheet as investments in infrastructure.
So instead of telling investors, we spent $3.8 billion this quarter, they said, we bought $3.8 billion worth of new assets.
Which meant their profit looked $3.8 billion higher than it actually was. It was a simple journal entry in the ledger. Debit asset, credit cash, no complex shell companies required. Just a lie.
And the scale, it was ultimately revealed to be an $11 billion fraud, is staggering. At the time, it dwarfed Enron. It was the largest corporate insolvency ever.
And it wasn't uncovered by the SEC or a Wall Street analyst. It was caught by a small team of internal auditors led by Cynthia Cooper. They worked in secret, often at night, digging through the company's own systems because they knew something was wrong. They are the real heroes of that story.
Truly. Okay, let's jump forward a few years to 2008. The great financial crisis is unfolding. And the name that dominates that era of fraud is, of course, Bernie Madoff.
The $64 billion question, as you called it earlier.
Now, everyone knows it was a Ponzi scheme. He took money from new investors to pay off old investors. The basic mechanisms are well understood. But what I want to focus on is the single biggest red flag that everyone, including the SEC, missed for decades: the auditor.
This is the detail that still keeps regulators up at night. Madoff Investment Securities claimed to be managing tens of billions of dollars for thousands of clients globally. You'd expect a firm of that size to be audited by a global powerhouse. PwC, Deloitte, EY, KPMG, one of the big four.
Right. You'd want an army of forensic accountants combing through every trade. Instead, the auditor of record was a firm called Freeling and Horowitz.
Which sounds respectable enough, right? Maybe a boutique high-end firm.
But in reality, what was it?
It was a tiny office in a strip mall in New City, New York. It was basically one room, a storefront.
One room to audit a $60 billion operation.
And the firm consisted of one active accountant, David G. Freeling. He was in his late 70s working from this tiny office. He didn't have a team of forensic analysts. He barely had a secretary.
So how does one guy audit a global hedge fund of that size?
He doesn't. He couldn't. He simply rubber-stamped the documents Madoff gave him. For 18 years, he admitted he didn't perform any actual audit procedures. He didn't independently verify the trades. He didn't even check to see if the bank accounts with the supposed billions actually existed.
And why? Was he just lazy? Incompetent?
He was hopelessly compromised. He and his family had millions of dollars of their own money invested in Madoff's fund.
No, that is the single biggest conflict of interest imaginable. Audit rule number 1. You must be independent in fact and appearance.
Exactly. If he found the fraud, he would not only lose a major client, he would lose his own life savings and his family's savings. He was financially incentivized to be blind. It's a perfect, tragic example of why auditor independence is the absolute cornerstone of the whole financial system.
It's just incredible. The biggest financial crime in history was hidden behind a strip mall storefront. Now, we've been very U.S.-centric so far, but creative accounting is a global language. Let's take a quick trip around the world.
Let's do it. Where to first?
Let's go to Europe. Italy, 2003. Parmalat.
Ah, Parmalat. The European Enron. Parmalat was a massive company, a dairy giant. They made milk, yogurt, cookies. They were a huge family-owned conglomerate, a point of national pride in Italy. But it turned out they had a 14 billion hole in their books.
14 billion euros. And the way they hid it, honestly, it sounds like a prank from a bad sitcom.
It does. It's almost comical in its audacity. They claimed to have a bank account with Bank of America in the Cayman Islands, and this account supposedly contained nearly $4 billion in cash.
Nice little rainy day fund.
The auditors, for years, would ask for proof of this cash. So Parmalat executives simply forged a letter on Bank of America letterhead confirming the balance.
Like they just made it up in Microsoft Word and put a fake signature on it.
Even cruder. It was essentially cut and paste, scanned, and faxed. The prosecutors later said it was a clumsy, obvious forgery, but for years the auditors just accepted the facts as proof. They never once picked up the phone to call the bank and verify it.
The old mantra of trust but verify, minus the crucial verify part.
Exactly. When a new auditor finally took over and said, hey, out of an abundance of caution, let me just double-check this with the bank, Bank of America's response was, we don't have an account for this company. We've never heard of it. The whole thing collapsed instantly.
Unbelievable. Okay, let's move over to Asia. Japan, 2011. Olympus, the camera company.
Yes, Olympus. This one is fascinating because of the cultural element involved, a practice known as tobashi.
Tobashi, what does that translate to?
It roughly means to make fly away. And it refers to a financial maneuver where you shift your losses off your company's books to hide them from investors, often by moving them to obscure shell companies.
So similar to Enron's SPEs.
Very similar in concept. Olympus had made some terrible speculative investments back in the 1980s during the Japanese asset bubble. When the bubble burst, they were sitting on huge, embarrassing losses.
So instead of admitting it and taking the hit to their stock price,
they spent the next 20 years hiding it. Their method was to overpay for acquisitions. They would buy other companies at massively inflated prices. The extra money they paid for these acquisitions wasn't for the company itself. It was secretly being funneled into shell companies to pay off those old investment losses from the 80s.
So they're buying companies not because they wanted the technology or the business, but because they needed a laundry machine for their old debt.
It was a very expensive and elaborate way to hide the truth. And this went on for 2 decades until a new CEO, Michael Woodford, who was British and the first non-Japanese CEO in the company's history, started asking questions. Simple questions like, why did we pay $2 billion for a small recycling company that makes no money?
And because he was an outsider, he didn't understand the cultural rule of silence and not rocking the boat.
He broke the Japanese concept of harmony. The board fired him for asking too many questions, but he went to the press and the police, and the entire 20-year-old scheme came crashing down.
Incredible persistence. Okay, let's hit our neighbor to the north, Canada. Nortel Networks, 2003.
This is a classic example of earnings management, driven by pure, unadulterated greed.
This was the return-to-profit scheme.
That's right. Nortel, the telecom giant, was struggling after the dot-com bust. In 2002, the top executives realized they weren't going to hit their profit targets for the year. So they decided to take what's known as a big bath.
A big bath. What does that mean?
It means you make the current year look as bad as humanly possible. You write off every bad asset you can find, you prepay future expenses, you accrue massive liabilities, you basically flush all the bad news through the system at once.
Why on earth would you want to make your company look terrible?
Because it dramatically lowers the bar for the following year. If you make 2002 look like an absolute disaster, it becomes very easy to make 2003 look like a miraculous recovery.
And why did they specifically need 2003 to be a recovery year?
Because their executive bonus plan had a special return to profitability trigger. If they could just show a profit, any profit in 2003 after the disaster of 2002, the top executives would share a bonus pool of $70 million.
So they deliberately engineered a loss in one year so they could engineer a profit the next, solely to unlock a wire transfer to their personal bank accounts.
It is arguably the most cynical form of fraud. It wasn't about saving the company or protecting jobs. It was purely about the payout.
And finally, let's bring it to the present day for the biggest one of all, China. Evergrande.
The scale of this one just makes the others look small. Evergrande is, or was, one of China's largest property developers. In 2023, Chinese regulators accused the company of overstating its revenue by $78 billion over 2 years.
$78 billion. That is the entire GDP of a decent-sized nation. How is that even possible?
It stems from how they recognize revenue. In China, real estate is often sold pre-sale. You pay for the apartment years before it is actually built.
Okay, that's common here too.
Right. But proper accounting says that money you receive is a liability, a customer deposit, until you actually finish the building and hand over the keys. You haven't earned it yet. Evergrande was allegedly booking all that cash as revenue the moment they received it.
So they were counting the chickens, not just before they hatched, but before the eggs were even laid.
And then they were using that fake revenue on their books to go out and borrow more money to buy more land to sell more unbuilt apartments. It was a classic Ponzi scheme, but fueled by real estate debt instead of investor cash.
And when the Chinese government tightened lending rules to cool the property market,
the liquidity dried up and the music stopped, the whole thing imploded.
And because real estate is such a huge part of China's economy, this sent shockwaves globally.
It did. It's a powerful reminder that these aren't just numbers on a page. When these giant companies collapse, construction stocks, people who paid for homes lose their life savings, suppliers don't get paid, banks are left with bad loans. The ripple effects are very, very real.
So we've seen the anatomy of the crime. We've been through the Hall of Shame. Let's talk about part 3, the fallout. What happens after the dust settles from one of these massive scandals?
Usually, the government steps in with a big regulatory stick. The biggest and most famous response to the Enron and WorldCom era was the Sarbanes-Oxley Act of 2002, known universally as SOX.
I have friends in finance who still shudder when they hear the word SOX. It's famous for being a paperwork nightmare. But what did it actually change in a meaningful way?
I think the most critical change was establishing personal liability for executives. Before SOX, a CEO could plausibly say, hey, I'm the big picture guy, I focus on strategy, I didn't know what the accountants in the basement were doing, the old Sheet and Schultz defense, I know nothing.
Plausible deniability.
SOX killed that defense. Section 302 of the Act requires the CEO and CFO to personally certify, to sign their names on the dotted line, that the financial statements are accurate and not misleading.
So they can't hide anymore.
If the statements turn out to be fraudulent, the executives can face massive fines and prison time, regardless of whether they knew the specific details of the fraud. It forces them to take responsibility. It forces them to know.
I remember President Bush, when he was signing it, said something to the effect of, "The buck stops here, and the buck is fake. You're going to jail."
That's essentially the spirit of it. But this whole episode sparked a massive philosophical debate in the accounting world that is still raging today. The debate between rules versus principles.
This sounds a bit academic, but bear with us, listener, because it really gets to the heart of why fraud keeps happening. What is the difference between these two approaches?
The U.S. system, called JAP Generally Accepted Accounting Principles, is a rules-based system. It's like a massive, incredibly detailed instruction manual. It says, if you have a lease that covers 75% of the asset's useful life, you must treat it as a capital lease. If it's 74%, you treat it as an operating lease.
It's very specific. Right. Checklist, black and white.
Exactly. But that very specificity creates loopholes. The smart fraudsters, like the guys at Enron, they don't break the rules. They read the rule book and design transactions that are technically compliant but ethically bankrupt. They might structure a deal to be 2.9% owned by an outsider because the rule says 3% ownership triggers a certain disclosure.
So they follow the letter of the law precisely to violate the spirit of the law.
Perfectly put. Now contrast that with principles-based systems like the IFRS International Financial Reporting Standards used in Europe and most of the rest of the world. That system is much broader. It says something like, the financial statements must present a true and fair view of the company's financial position.
It's more like a guiding principle. Don't be evil.
Right. It relies on the professional judgment of the accountants and auditors. Does this look right? Does this reflect the economic reality of the transaction? But the problem there is that judgment is subjective. It's harder to enforce in a courtroom.
And the great paradox here is that we see massive fraud happening in both systems. Enron happened under the strict U.S. rules. Parmalat and, more recently, Wirecard happened under the European principles.
It really suggests that if someone is truly determined to lie, the specific rulebook doesn't ultimately matter that much.
Speaking of Wirecard, that was a huge scandal in 2020. SOX had been around for 18 years by then.
Right.
We had all these new regulations. Did the system fail?
Regulation is a deterrent, not a cure. It can eliminate bad actors. Wirecard was a German payment processing company, a tech darling. They claimed to have $1.9 billion in cash sitting in trust accounts in the Philippines.
And let me guess, just like Parmalat.
The money didn't exist. The accounts were fake. The auditors, Ernst & Young in this case, had failed to verify the cash directly with the banks for years. They relied on documents and confirmations provided by a third-party trustee who was in on the scheme.
It just seems like call the bank directly is the one simple step that auditors keep skipping over and over again.
It seems to be the Achilles heel of the audit profession. And then, just this year, 2024, we have the case of B.F. Borgers.
This is the most recent one on our list, and it feels different.
It's different because the fraud wasn't at the company being audited. It was the audit firm itself that was the fraud. B.F. Borgers was an audit firm in Colorado. They filed reports for over 1,500 SEC filings for various small companies. The SEC found that in 75% of those filings, they hadn't even done the work.
What do you mean they hadn't done the work?
They just fabricated the audit documentation. They would copy and paste work papers from previous years, change the dates, and sign off on the audit. They were selling the appearance of an audit to companies that needed one to be publicly listed.
So it's like buying a car inspection sticker from a guy in an alley who never even looks at your brakes.
That is exactly what it was, a fake audit factory. It just goes to show that no matter how many rules and regulations you have, you can't regulate away fundamental dishonesty.
So if humans keep failing, if auditors are lazy or compromised or just plain tricked, is technology the answer? We hear about AI revolutionizing every other industry. Can AI catch a Bernie Madoff?
It is the new frontier, and there's a lot of hope there. We are seeing the rise of things like continuous auditing using deep learning and AI.
How does that actually work?
Well, a human auditor can only ever spot check. They might look at 50 transactions out of 50,000. It's a sample. An AI can look at 100% of the transactions instantly, and it can spot anomalies and patterns that humans would never, ever miss.
Like that thing called Benford's Law. I read about that.
Yes. Benford's Law is fascinating. It's a mathematical observation that in naturally occurring sets of numbers, like utility bills or stock prices or street addresses, the leading digit is most likely to be a 1. In fact, about 30% of numbers in the real world start with a 1. Only about 5% start with a 9.
That seems so counterintuitive. You'd think all the digits would have an equal chance.
You'd think so, but they don't. But here's the catch. When humans try to make up random numbers to fake a ledger, we tend to distribute the leading digits pretty equally. We put in too many 8s and 9s and not enough 1s and 2s. Our fakes don't look natural.
So the AI scans the entire general ledger, sees that the distribution of first digits is unnatural, and flags it for review.
Exactly. It says these numbers look cooked. It's an incredibly powerful tool for fraud detection. But of course, as the detection gets better with AI, the fraudsters will likely start using AI to generate more natural-looking fake numbers.
So it's a perpetual arms race. Robo-auditor versus robo-fraudster.
It is, and always will be, the nature of the game.
Well, on that slightly dystopian note, let's wrap this up. But before we go, you found a detail about an award that I think sums this entire deep dive up perfectly.
The Imaginary Numbers Award. I love this.
This was from the Ig Nobel Prizes, the parody Nobel Awards that honor achievements that make you laugh and make you think. And this was in 2002, right in the thick of the Enron and WorldCom scandals.
The recipients of the Ig Nobel Prize in Economics were the CEOs and executives of Enron, WorldCom, Arthur Andersen, and a dozen other companies that imploded that year.
And the citation for the award, what did it say?
It said they won the prize for adapting the mathematical concept of imaginary numbers for use in the business world.
It's funny, but it stings, doesn't it?
It really cuts to the core. These people treated business not as a mechanism to provide value, to build cars or supply energy or connect phone calls, but as a theoretical math problem where the variables could be adjusted to fit whatever answer they wanted.
And that brings us right back to the fraud pentagon, that fifth element, the arrogance.
Absolutely. The systems we all rely on, global trade, the stock market, your retirement fund, they all function on a baseline assumption of truth. We assume a dollar is a dollar and a sale is a sale. When the people at the top decide that reality is optional, that the map is more important than the territory, the damage is truly limitless.
So here is our final provocative thought for you, the listener. The next time you see a company that is constantly, quarter after quarter, beating Wall Street's expectations by exactly 1 penny, or you see a company that reports perfectly smooth, steadily climbing profits in a market that is chaotic and volatile,
Ask yourself, is this unparalleled operational excellence? Is this management genius at work?
or is it creative writing?
It is a question worth asking.
Thanks for diving deep with us. Keep your eyes on the numbers, and we'll see you next time.